Most people think $750,000 isn't enough to retire, especially not at 60. That belief is everywhere: financial blogs, YouTube videos, and even from some advisors. And at first glance, it might seem true. Retiring at 60 means possibly 30 plus years without a paycheck. Add in rising healthcare costs, inflation, and stock market volatility, and $750,000 can feel tight. But here's the truth. With the right planning, $750,000 can absolutely fund a confident, secure retirement starting at 60. The problem isn't the number, it's the strategy. And in this video, I'm going to walk you through the exact step-by-step approach that I would take a client that had $750,000 and was ready to retire at 60. I'll show you the financial traps that can sabotage early retirement success, the 5 strategic decisions that make or break a $750,000 retirement, and how to bridge the gap between Medicare and Social Security without draining your savings. If you're new here, I'm Kyle Kuyat, a certified financial planner who's worked with hundreds of clients in this same exact situation. And I've seen firsthand how the right decisions made early can turn a modest nest egg into long-term financial independence. Let's dive in. Let's start by laying out the numbers. The average household headed by someone over 65 spends about $52,000 a year, or roughly $4,300 a month. If you retired at 60 with $750,000, you'll need to fund somewhere between a 2 and 10-year gap before Social Security turns on and a 5-year gap until Medicare. In total, that's between $103,000 and a $516,000 gap in potential expenses coming entirely from your investments. Now, this is going to depend on when you claim Social Security. The issue is you're not just planning for the next 2 to 10 years, you're planning for 30 or even more. Retiring at 60 means you can live well into your 90s. In fact, my grandfather lived until he was 95. That's nearly 3 full decades of living expenses, market volatility, healthcare inflation, and unexpected life events. The challenge isn't just, can I afford to retire today? The challenge is, can I stay retired for the next 30 years without running out of money? And can I remain confident that I will be okay? This is where the reality check comes in. It's not just about whether $750,000 is enough in theory. It's whether it's durable under real-world conditions, and that's going to be personal for everyone. What happens if the market drops 20% right after you retire? What if inflation runs at 4% for the next decade? What if you have a $10,000 medical bill in your second year of retirement? And what about one-time expenses that can add up? The good news is, with strategic planning, we can build in safeguards for all this. But it starts with understanding that $750,000 is not a fixed number. It's a tool. And how you use the money you've saved determines whether it lasts. So now that we've covered the risk, let's walk through the strategies. The first strategy is managing your expenses. Before we talk about investments or Social Security timing, we need to build a retirement budget that's both realistic and resilient. When it comes to budgeting, our clients abide by the Live, Give, Owe, and Grow framework to set a direction for their annual budgets addressing all of those areas. This breaks things out simply so you can understand where your money is going at a high level and set aspirational levels of spending in retirement as well. First, start by categorizing your spending. We want to break this down into household expenses like your mortgage, rent, utilities, and insurance. Transportation can include things like your vehicle payments, gasoline, and maintenance. Of course, there's medical expenses like premiums, prescriptions, and out-of-pocket costs. And of course, there's your lifestyle you want to live in retirement, things like travel, dining, and entertainment. And then lastly, things like family support, whether that's gifting to your grandkids, elder care, etc. Next, what you want to do is split expenses into essential and discretionary. Your essential costs are things that you'll need no matter what: housing, food, medical care, etc. Discretionary costs are lifestyle choices, things like travel. And that distinction will become critical when market conditions can force your spending to adjust. The goal isn't to cut out everything that's fun. That's not a retirement that anybody wants to live. The goal is to understand what you can cut without jeopardizing your quality of life in retirement. We call this the lowest acceptable spend in retirement, and it's the amount of spending that you would need to feel reasonably confident about to be able to spend, or else you wouldn't retire. That creates a target for your retirement spending that you can stress test with parameters for cutting back to essential spending in poor markets or increasing to max spending or aspirational spending if the market does well. Now, you need to really be honest about what you can actually live on in retirement or the things you would truly want to achieve with your retirement years. It does no good to tell yourself that you can live on less money just to get out of working. It has to be an amount that you could realistically be happy with and live comfortably on. In fact, I recently had a client tell me that they wanted to retirement-proof their home before they retired. They knew that once they retired, they'd be looking around and finding things in the house that needed fixed. One of the things they wanted to do was eliminate this risk entirely before they turned off their income. But however you decide to approach it, we advise clients to set aside a cash cushion specifically for these lump sum and one-time expenses. They're inevitable in retirement. Whether or not you plan for them is up to you. Now, expense control is essential, but the healthcare planning strategy determines financial survival during the Medicare gap. The second strategy is bridging the Medicare gap. From 60 to 65, you'll likely be 100% responsible for your healthcare costs. And healthcare isn't cheap. The average couple retiring today needs somewhere between $184,000 and $383,000 to cover medical expenses throughout retirement. Now, a large chunk of that happens before Medicare even kicks in. For early retirees, you can explore ACA marketplace plans. Many retirees can qualify for subsidies based on your modified adjusted gross income. But you need to budget realistically. Set aside somewhere between $1,500 and $2,000 per month for premiums and out-of-pocket costs. If you have an HSA, this could be the time to use it. Although you can't use your funds in the HSA to pay for health care premiums, you will be able to pay for them whenever it comes to Medicare premiums. Your HSA withdrawals for qualified medical expenses are tax-free, and many retirees forget to leverage this triple tax advantage account. An additional and little used benefit with HSAs that often gets ignored is the one-time rollover from your pre-tax account. You can actually max out your HSA one time in your life by rolling over funds from your 401k or IRA. That's another $9,550 moved into a tax-free environment for you at age 60. Those HSA funds can be saved to pay for Medicare premiums or even long-term care expenses that very well could pop up later in life. Long-term care is another wild card. You can either purchase a long-term care policy in your 50s or early 60s, or you can choose to self-insure by earmarking a portion of your portfolio or using the equity in your home. Whatever path you choose, the key is having a plan. Medical bills are one of the biggest risks to retirement security, especially in the early years before Medicare coverage is in place. Now that you understand these critical planning elements, click the link in the description to book a call, and I'll analyze your specific situation and show you exactly how to optimize your retirement plan. Now, let's talk about how to make your $750,000 not just last, but grow. At 60, you still need growth. In fact, being too conservative is one of the most common mistakes that I'll see early retirees make. Here's why. A 30-plus year retirement means inflation, and that can be your biggest enemy. If your money isn't growing faster than the cost of living, it's shrinking. A typical early retiree portfolio might look something like this. 60 to 70% stocks for growth, 30 to 40% bonds for fixed income for stability, and you can even add things like real estate or income dividend-focused ETFs for steady cash flow. And a cash buffer for expenses could also be useful. Your asset allocation is one of the most important decisions that you'll have to make throughout your investment journey to make it successful in retirement. Using a bucket strategy to benchmark your overall allocation can make a lot of sense. In this method, we use your annual spending needs from the portfolio to drive the initial allocation decision. That could look something like this. 1 to 3 years of your spending in short-term investments like high-yield savings accounts, money markets, or CDs. 5 to 7 years of spending in medium-term investments like bonds, treasuries, or funds holding those types of securities. And the remainder of your assets in long-term growth strategies like the stock market. No more than 10 years of your investments should be in the short and medium-term buckets. And in fact, a 30-plus year retirement that would often be way too conservative to even begin with. But asset allocation is just one piece. You also need a rebalancing plan, and that means periodically selling what's up and buying what's low to stay aligned with your goals. This protects you from overexposure during bull markets and can help you capture and secure those gains. Also, you'll want to consider the order of your withdrawals. Likely, you'd want to use taxable accounts first for flexibility, do strategic Roth conversions during your low-income years. This is particularly important if your RMDs project to be way outpacing your spending later on in retirement and if you don't have charitable giving goals. And lastly, defer your IRA withdrawals until RMD age if possible. This is about making your investments work together to support your lifestyle, reduce taxes, and outpace inflation. Now, investment strategy is crucial, but the Social Security optimization plan can truly determine long-term income security. That brings us to Social Security. Now, most people know they can start claiming at 62, but here's what many don't realize. Delaying benefits until you're age 70 can actually increase your monthly check by up to 75%. That's huge. If you retire at 60, that creates a 10-year gap. But if you strategically use your $750,000 that you have set aside to bridge that gap, the reward is significantly larger, guaranteed income for the rest of your life. Social Security isn't just a check. It's inflation protected, lasts as long as you live, and offers even spousal and survivor benefits. Here's where delaying can make sense. First, you have other income sources or portfolio access. You're in good health and expect to live well into your 80s or even beyond, and you want to increase your income security later in life. Now, if you're married, delaying at least one spouse's benefit becomes even more important as it creates a higher survivor benefit, should one of you outlive the other by a number of years. We often recommend that the higher earning spouse delay their benefit to truly maximize this. I recently worked with a 6-year-old couple that had saved right around $750,000. They want to spend around $60,000 a year in retirement, and using traditional planning, they had about a 79% chance of success. But here's what changed everything. When we implemented the Social Security optimization strategy by waiting until full retirement age instead of claiming at 62, their probability of success jumped way into the 90s. And waiting until age 70 increased it even more. They realized that once their benefits kicked in, they could actually spend more than they were even anticipating in retirement. Talk about a good surprise. Now, even claiming at 62, they would have received almost $1.2 million in their lifetime from Social Security benefits. Waiting until full retirement age increased it to about $1.4 million. And at age 70, it was about $1.5 million. This is why the bridge strategy works. By strategically using the part of their assets, they were able to cover expenses until Social Security fully kicked in at its optimal levels. Then they relied primarily on the guaranteed income for long-term security that Social Security provided. Social Security is one of the most powerful levers for most people in retirement planning, but only if coordinated with your withdrawal strategy. Social Security can only be optimized so much, and at the end of the day, it's just one piece. But the withdrawal strategy that you use determines how much and how long the money that you've saved actually lasts. Finally, let's talk about withdrawals. The classic 4% rule says you can withdraw 4% of your initial portfolio annually and not run out of money. However, I prefer a more dynamic spending strategy to allow for increased spending, especially when markets are positive. Using withdrawal rate guardrails, you could spend somewhere between 5 and 5.5% of your portfolio balance and adjust spending based on the withdrawal rate in future years. For example, if your withdrawal rate creeps up from 5.5% to 6% of the portfolio balance, you make a slight adjustment to your spending. This is, by the way, why we said earlier, knowing your lowest acceptable spend versus your essential spending is so important, especially when using dynamic spending methods like this. And that's where dynamic spending comes in. Instead of withdrawing a fixed amount every year, you adjust based on market conditions. For example, if you were to withdraw 4% in up years and cut back your spending down to a 3% withdrawal in down years, you could use guardrails to raise or lower your spending based on your portfolio's value. And studies often show that this approach can even extend your portfolio's lifespan dramatically. And remember, not all of your income is going to be coming from withdrawals. You may have dividends, interest, or even part-time income in your early retirement years. Coordinating all this, your expenses, Social Security, portfolio drawdown, can create a retirement plan that adapts instead of breaks. So now that you understand this complete strategy, let's make sure that you can implement it correctly for your specific situation. We've covered the importance of each strategy, so let me show you how they all come together in a cohesive solution. If you want to retire at 60 with $750,000, or depending on how much you have, you'll need an integrated, flexible, and well-coordinated plan. Here's how that looks step by step. First, we want to layer time segments into your plan. We break retirement into 3 separate phases. Your early years or your go-go years, this could be between 60 and 70. These are typically filled with high activity, high spending, and no Social Security yet. Your middle years are your slow go, somewhere between ages 70 and 80. This is where your Social Security will be in full effect. Medicare will be as well, and your spending often will level out. And lastly, your late or your no-go years. This is years 80 plus. This is where your medical expenses can increase and your lifestyle expenses will drop. By segmenting this way, we can tailor withdrawals, asset allocation, and budget controls to each decade. Next, you want to use the bridge strategy to defer Social Security. The goal is to use taxable accounts and Roth conversions from age 60 to 70 and delaying Social Security to at least full retirement age or age 70 to maximize your benefits. This window is the golden years for your tax optimization, converting your traditional IRA to Roth when income is low and minimizing your RMDs for later on in your 70s. Also, you want to manage your modified adjusted gross income if you're on ACA. Next, we want to implement a flexible withdrawal policy. Dynamic withdrawals means that you can adjust based on your portfolio health. In strong markets, you can withdraw more, and in weak markets, you scale back. Guardrails help you set up upper and lower limits for your spending. For example, start with 3.5% withdrawal rate at age 60. You can increase it to 4% by age 70 when Social Security kicks in and you're taking less out of your portfolio. And you can use a rule like no increases in withdrawals if your portfolio drops by 10%. Next, we want to reinvest and rebalance with purpose. At least once a year, review your portfolio. If stocks have performed well, sell a little bit and fund the next year and reinvest into your underperforming assets. Again, you've already won the game. You want to make sure you keep playing it. This will keep your portfolio risk balanced and ensure that you don't overspend. I'd recommend looking at this quarterly or at least semi-annually. Next, you may want to consider a bond ladder or an income floor. Build out somewhere between 1 to 5 years of cash flow using CDs, short-term bonds, and high-yield savings. This will help you avoid selling growth assets in a downturn and gives you dry powder to accelerate Roth conversions in a down market. Next is account coordination. Which account do you pull from first? Ideally, your taxable account is where you'd want to go first for flexible withdrawals and capital gains management. Your IRAs and your 401ks, you'd want to distribute and convert strategically during your lower income years, and then draw again after RMDs will kick in. And then lastly, for your Roth, let it grow for later unless tax-free income is needed. Next, expense, discipline, enjoy spending. Now, this strategy isn't about deprivation. It's about awareness and living a retirement that you want to live. Set a core lifestyle budget. Then create what I like to call a joy fund, which is a fixed annual amount that you'll use on travel, fun, gifts, whatever it is you want to do. This keeps spending joyful and guilt-free. Lastly is your healthcare safety net. Don't wait for a crisis. Price out healthcare options, ideally before you retire. You could even consider high deductible plans paired with HSAs and build an emergency fund just for healthcare costs. This, of course, will depend on your specific health situation, but without a strategy here, even the best investment plan can unravel. Lastly, you want to monitor and adjust your plan annually. Your plan isn't just to set it and forget it. You want to continually monitor your spending and your budget, adjust your withdrawal percentage based on your portfolio's health, reassess what you're doing for healthcare and insurance, and run ongoing tax projections, not just for this year, but also for future years. This is where working with a professional can add the most value, helping you adapt without stress. Now that you understand exactly what I would recommend for a client with $750,000 at age 60, you can see how strategic planning makes early retirement possible, even with this amount of money. If you want help implementing this complete retirement strategy and ensuring it's optimized for your specific situation, then click the link below to book a call, and I'll analyze your circumstances and show you the optimal way to plan your dream retirement. Thanks again for watching, and I'll see you in the next video.